Hey everyone, how you doing? As most of all of you know, but for those of you who are new to the firm or haven't met me, my name is Dr. Jason Van Duyn, and I'm excited to talk about some things today. So we're getting so many questions and comments lately about the market and the economy and what's going on. So what we did is we decided to do this presentation based on the information that we have from the first half of the year. And what we're going to do is we're going to kind of take that and we're going to try and add some context to it by looking at past either expansions or contractions, and just to try to gain some insight on what we might be able to expect here over the next 3 to 6 months. So what we're going to do is we are going to look in the context of a couple different things. But as Gary had mentioned, you know, if you guys, everyone who's muted, I think is great. Feel free to turn on or off your cameras, whatever you're most comfortable with. And then we'll take questions at the end. Also, a lot of people don't like to ask questions in a public forum. Even though, trust me, probably everyone else has the question that you have. So feel free to reach out to whichever request advisor that you work with, you know, or either by phone or email, and we'd be happy to answer anything that we can for you. So, you know, like I said, we're going to kind of look at things in the, you know, what's going on in the economy in the context of a few different things. So and basically, I'd say the market's way up, right? We all know that. It's been great for everyone. But what sort of headwinds do we have? What are those, and are they going to derail the economy and the stock market or not? And if so, what should we be looking for? And so the things that we're going to look at as headwinds are things like the government. You know, are they going to kill the market with taxes? Are they going to kill the market with a fumbled stimulus kind of pullback? Is the stock market just so high it's going to come down just because it's so high? What's going on with bonds? Is inflation going to derail us? So we're look at all of those things and basically, are they serious, or do we really think they're going to derail us, or is it something that is manageable and we think that they may not derail us? So and we're going to look at that in the context of a couple of different things. The first one is just the economy and kind of what is going on with it. So the economy has been better than I had expected, quite frankly, through the first half of the year, and better than most people that I talk to. And what I would say is, I would think that the growth rate in the economy has probably peaked, and that probably happened in the second quarter. That doesn't mean I don't think that everything's going to contract and we're going into a recession anytime soon. But what I do think it means is that growth is going to be decelerating. So I think we're going to have slower growth probably the rest of this year as well as the beginning of next year than we've had. The question is that slow growth going to turn into something negative, to where you know, it is detracting from your returns, or is it just going to be growth but a little slower than what we've had? And if you look here, I find this a little bit confusing, but a good stat. So 2021 up until you can see down here 6/28 of 21. So up until 6/28/21, the growth in the U.S. had been really good. You know, 3.9% is crazy. Just to give that some context, the GDP last year, which I think most people on this call, and actually how I feel a little bit as well. I mean, I know the real numbers, but it's not how they don't reflect my feelings or my experience as an advisor nor as an investor. So last year, you know, most of us experienced COVID, right? A huge downturn, 40% in 40 days, but then it rebounded very quickly. And as far as our portfolios and the statements that we look at, or when you go through our website on Account View, you know, your investments started to look a lot better. But what that kind of masks is this number, this negative 3.5. Negative 3.5% is not stock market growth. It's actually GDP, gross domestic product. So it is the total goods and services produced in the United States contracted by 3.5%. You might think, well, you know, that's not really that much. That's pretty reasonable. And it might not sound like much, but it's the largest drop since the Great Depression, not the Great Recession we had in 2008, the Great Depression, you know, that we had in the 30s. So it was a big contraction year. Again, I don't think most people, at least that were able to maintain their job or their business, I don't think most people necessarily felt that because of government stimulus and because the stock market rebounded so quickly. But last year was the worst year for GDP in 80 years since the Great, well, you know, almost 100 years since the Great Depression. That's a big deal. That has come back a lot, as you can see, by 3.9. But what LPL's analysts are estimating for the full year growth is only about 6.5. So you can see if you multiply 3.9 times 2, you get way more than 6.5. That's because they think growth is going to decelerate. So they think we're going to get about 4% growth in the first 6 months, but only about, annualized, and only about, 2 to 2.5% annualized growth in the second half. So we expect growth to slow down almost in half, in the second half of the year. And this is almost October, so we've already seen that happening a little bit in the third quarter. You could there look at other, emerging markets developed in global average. So what I think is interesting is this number here. It shows that developed economies, basically Japan, Australia, and Europe, are not doing as well as we are. So they had a worse contraction. And again, 0.4% might not sound like a lot, but it's like $100 billion, right, of goods. I mean, it's a lot. So they had a worse contraction, and they've had a worse recovery. And quite frankly, it's the exact same thing that happened in 2008. They did poorly in 2008, and really a lot of the world has not really come out of it, even until COVID hit. They did austerity where we kind of spent our way out of the problem. They tried to cut their way out of the problem through reduced spending, and that did not work. Britain, and most of Europe went through basically a triple dip recession over a 10-year period of time, where we came out of it and grew a lot. So what I would say is that GDP is going great. That's good. The whole economy is growing. That's helping, of course, spending and, the stock market gains. So let's talk a little bit about that. So since World War II, you can see right here, this 5.3 years, the average expansion in the economy has lasted about 5.3 years. Now, why I think this slide is interesting and why I chose to talk about it is people that I talk to tend to fall into two camps. Camp number one says, Jason, yes, the longest expansion in history, right here, from July of 2009 until spring of 2000, had gone on for 10.7 years. It was the longest expansion in the history of the United States of America, right? And then COVID happened, and it was only for a couple months, and then we've come out of it. Technically, that began a new, cycle, right, or a new expansion. So the pessimistic people, and I don't mean that negatively, it's just that they pessimistic in the sense, they tend to say, well, Jason, we're not going to get a 5.3-year expansion this time around because this is basically just a continuation of the 2009 expansion. We just had that little COVID blip. It didn't last very long. And now so it's a continuation. So if we get another 5 or 6 years of expansion, that's going to be like a 15 or 16-year expansion going all the way back till July of 2009. And that's probably not going to happen, especially with all of the headwinds, that we're facing, inflation and potentially rising interest rates and, supply chain issues and so on and so forth. There's a whole other camp of people, and I'd say most analysts and economists probably fall into this camp that say, no, that, COVID ended that expansion, 10.7 years, that's it. Now we have a whole new expansion, and that expansion is being fueled heavily by government stimulus and super low interest rates. And that could potentially last 5.3 years or even longer. So again, it kind of depends on what camp that you're in, but I think either way, this slide is probably pretty supportive of at least a decent next couple of years. It might not get to the 5.3 average, but at least it'll be okay for the next couple of years because we have this new expansion happening. And again, we'll look at the 4 things that I think might be able to stop that, at a year or two, instead of having it last all 5.3. So again, I've got hundreds of slides that I kind of look at and choose. I think that this one, even though it might not be what the average person talks about or is concerned with, is interesting. So a lot of our trade is based on the strength of the dollar. If the dollar is strong, it makes things like commodities more expensive, right? Because all commodities in the world are denominated in dollars. So a weaker dollar, some people feel is weak for our country. I don't know if I buy that. But a weaker dollar means, think we all live relatively close to Canada. If the Canadian dollar stays the same and ours drops 10%, we don't notice a difference. We're just going along about our day spending American dollars. But Canadians can now buy everything cheaper here at a 10% discount. If our dollar drops 10% and the Canadian dollar stays the same. So if our dollar gets cheaper, it doesn't really make a big difference to us. But to other people, they can now buy more of our stuff and it helps us export. Exporting is great, especially in a world where people are starting to see kind of some cracks in their supply chain, and a lot of companies are bringing it back. I read the other day that Apple 5 years ago had 38% of like its critical infrastructure in the US. Today it's over 70%. So in 5 years, they've basically doubled the amount of like supply chain infrastructure they have just in the United States. That's a huge deal. So if a bunch of other companies kind of start to do that, if you read recently, Michigan has kind of been out of shape because Ford is investing like $11 billion in making batteries and electric cars down south instead of here. But they're making it here. It's not in Mexico and it's not in China. You know, so a lot of that critical infrastructure is coming back to the US. If that could be combined with a weaker dollar and we could start exporting more things, that's great. And that would, I think, help our economy. Something though that, you know, they call here the twin deficit. So the twin deficit is the current account. That's a fancy way for economists to say the budget deficit, right? Or excuse me, trade deficit, the trade deficit, and the budget deficit as a percentage of GDP. And you see how that number has just plummeted. You can see, though, that it tends to follow, I mean, right here being the exception, but this goes all the way back. I mean, this is 8 years older than I am, for goodness sake. So this goes back far. So you can see they kind of trend together, right? Kind of the dollar index, basically the strength of the dollar, and the US twin deficit, which is trade deficit and budget deficit. And as you can see, that orange is just way down. If the dollar follows it by that much, one of the questions that I get a lot is, what about Bitcoin? What's going on with Bitcoin? Is it a real thing? One of the ways that the US is able to do everything that it does, whether it's fight terrorism, whether it's try to get people to have good corporate governance, whether it is to put sanctions on people, kind of anything that the US is trying to do is based on people's strength in the dollar, right? They believe in a strong dollar. And if people start to kind of not believe in that dollar, two really bad things happen to us. Number one is interest rates go way up, right? The government can't sell their bonds because no one wants them. The bonds are what finances our debt. So of course, instead of selling them at 1.5% for a 10-year bond, they've got to sell it at 4%. Now a ton of our budget goes to paying off our debt. We don't have as much money. We either have to raise taxes drastically or cut spending drastically, which kills the economy. So this, I think, is one of the big things that, and you'll sense a theme in everything that I'm talking about. This will kill the U.S. If the dollar drops like this, and we see a 20% drop from here in the dollar in like a year, that is a huge problem. Mainly because people's confidence in the dollar will be eroded. And the fact that we can run these huge deficits is because the whole world runs on the dollar. The whole world runs on the dollar. And if we can't, if they don't have confidence in us and they start to use Bitcoin or maybe a basket of other currencies, the euro, the yen, the Swiss franc, the pound sterling, and instead of just using the dollar, they start to use like a basket of other currencies or potentially crypto, that very much cripples the United States in general, and interest rates skyrocket, and that could hurt us. Now, if the dollar trends down, so if our budget deficit is not as bad as it is right now next year, because we're not spending like crazy, and the dollar just kind of trends down a little bit over time, I think we're going to be fine. But if this continues, and we see these deficits and trade deficit and budget that are leading to these huge numbers here, the twin deficit number, and the dollar even gets close to that, I think that could really hurt the U.S. Both short and long term. Again, is that going to kill us today? No, but if it goes down fast, it can have a big impact. So that'll be something that we're watching. Another big thing that's happening is policy, right? I mean, the government's basically controlling the stock market right now. They're doing so through, tax cuts during the Trump era and through super easy money through the Fed, right? Just, printing money basically and handing it out to anyone who wants it. Whether that's in the form of a PPP loan or of an extension of unemployment benefits or buying government bonds, in order to keep the interest rates low. So they're doing a bunch of different things, way more than like, for example, when I was in business school 25 years ago, I mean, there was like one lever and it was change the overnight lending rate. Now they've got 5 or 6 levers and all of them are pushed to the max. So the government, that policy and kind of how you unwind that or slow that down in order to, that on that last page, get that orange line back up to a more reasonable level is going to be super important. And if the government bungles it, it's going to be a big problem. So one of the things that clients talk about all the time, I'm all the time, is Jason, taxes. What are we going to do with taxes? Are taxes going to kill the stock market? And I say my answer is probably not. So what this graph here is this chart, not a graph. This chart shows the dates of corporate increases over here, right? Increases in the corporate tax rate. And then they list the old rate and they list the new rate. The legislation name, which I think anyone cares about. And then here's the stock market returns, right? S&P 500 returns. The 3 months before, 3 months after, 6 months, and a year. As you can see, in a lot of these cases, you don't see a lot of red numbers. And a lot of times when I point this out to some clients, they say, well, Jason, of course, because this is a historically large increase. Well, I mean, Trump reduced it from 35 to 21, right? I've actually seen 2 different interviews with the main negotiator for the Republicans at that time, and he just kind of laughed and said, I never thought we'd get to 21. I thought we'd be at 26 to 28. That seems like a good equilibrium rate. I'm surprised we got to 21. The Democrats are not going to let that stand. They're in charge right now, whether some people like that, some don't. But they're going to change that. They don't like that. They want the government, they want these corporations to pay more. Corporations actually pay a very, very small amount of the overall tax in the U.S. anyway. Households pay almost all of it. But still, they think that having a ridiculously low tax rate doesn't really make us that much more competitive in the global scene. And they want them to pay more. Again, I'm not here to agree or disagree with that. I'm just telling you what the people in power are doing. But you could see some pretty big increases, like 24 to 31, 31 to 40, 42 to 51. I mean, 51% in 1950. And 1950 was a boom time, and corporate tax rates were still 50%. They even went up to 53 at one point, which is crazy. But if you'll notice, there's not a lot of red here. And most of the red that is here is in here in 1941. These are the big down numbers. So a lot of people point to this and say, I knew it. I knew corporate tax rates were going to go up and it was going to kill the stock market. But something else happened. If you look at the date here, 9/20 of 41. So I'm not going to do any quizzes on this because I don't think Gary wants me having everyone unmute and blurting out answers. But something really big happened right after this tax increase. And it was in December of 1941. I think it was December 8th, Pearl Harbor. So I think a lot of these red numbers are probably a lot more of a function of, at that time, the largest attack basically since our independence on the United States of America. So I think that's probably why you see a lot of these big red numbers, is because of Pearl Harbor and probably not because of the corporate tax. So again, I would say, Biden and the Democrats kind of want to go from 21%, where it's at now, to like 26 to 28. I think they're going to end up at the higher end of that, which is halfway between 21 and 35, where it used to be, it's 28. So again, I would suspect if you do that, they're going to go, corporations are going to pay a little bit more, and it might hurt the stock market a little bit, but probably not that much. You can actually calculate how much profit is going to come out if they did that, and then you can multiply that profit times what's called the PE ratio, and you can come up with like a total dollar amount of all the corporations in the S&P 500 and how much money is going to come out of, how much profit is going to come out, and then how much that should affect the stock market. And if you kind of do the math on it and back your way in, it's about 3 to 4%. So again, I think that that's bad. I'd rather that not happen, but I don't think it's something that is going to actually like demolish the stock market. So please, a lot of people, if you have questions, feel free to ask later on. And then this is the same thing. I won't spend as much time on this, but higher capital gains, this is this exact same type of chart, date, old rate, new rate, and how the market's doing. And again, I'm not saying I support the Democrats or their tax increases, but if you look at what they're trying to do on capital gains, they only want to tax people on over $1 million. So if you have over $1 million of total income, including capital gains, anything over $1 million, still everything under $1 million, you're the same. But everything over $1 million, they're going to tax you at a higher rate, like a pretty substantially higher rate. I'm not here to say whether that's good or bad or fair or not fair, but those people that have well over $1 million of income on a consistent basis, they're not spending. So from our perspective on this call of, is this good or bad for the economy? Again, I'm not arguing it's fair, it's good for the millionaires, but what I am arguing is from an economic perspective and from your portfolio perspective, taxing the wealthiest people who all make over $1 million and then transferring that money and giving it to lower middle class and poor people who spend 100% of their income is good for the economy. Less saving and more spending is good. It drives our economy. We don't need more capital. There's so much capital in the world, interest rates are zero, right? We don't need to give millionaires more capital to go invest and drive interest rates down. They're already zero. So to give that money to to the lesser privileged people, again, I'm not saying I support it, but from strictly an economic perspective, it should actually drive the economy and therefore the stock market. So I don't expect capital gains. Again, if we're talking about different headwinds, we're on our third one, or kind of the second of just taxes in general. I don't think capital gains are going to totally derail the economy. So let's look at stocks. So the stock market has been awesome, right? I mean, we all know that, right? All of our portfolios look great. Every time you log into Account View, you go, wow, look at that, it's great. The question is, are they too high? And as a result of them being too high, are they going to come down anytime soon? And whether that's interest rates or inflation or whatever, what is going to cause that to happen? So I like this chart a lot. So this shows the S&P 500, the first year after the exact low point. So at the beginning of an expansion, same ones we talked about earlier, at the beginning of an expansion, how much growth do you get? I'm looking at the average is 42%. This is why anyone who sells while the market is low is crazy, because you're going to miss that 42%, or you're never going to get in at the right time, and you're going to miss that huge bump. So that is the first year kind of off of the low. So don't ever sell when the market gets bad. We'll talk about like in some bonds, and how we can maybe do that a little bit more efficiently. And then in the second year, sometimes it's positive and sometimes it's negative. As you can see, the positive times, right, in the second year, average around 12.7%. Not too bad. It's not bad after a 42 year, right? But then there's a couple times it was bad. Actually, 2009 was bad, right? It was the worst one. You lost almost 20% in the second year. But the average is down around 10. What I think that this shows that I think is really important, and quite frankly, I don't know that the general public kind of wraps their head around this in the proper way, is an expensive stock market does not cause a recession or necessarily a drop in the stock market, right? Ever. It's never happened, right? Stocks have never been like so expensive that they just come crashing down. There's usually something else, that causes that to happen. And I think that's what we're looking at today. And that's the important thing is, what are these something else's? And are they going to be a big enough deal right now to kind of put the brakes on the party? Or what else are we watching for? Because if it does become a big deal, then it will put the brakes on the party. Or if it's all managed properly, right, we could get maybe closer to that 5.3-year expansion that we looked at a couple slides ago. So I like this chart. I think that it shows that, even in the second year, things can be great. And a lot of the downturns are really not that bad, right? 10%, yeah, I mean, it hurts to look at your portfolio and see 10%, but I'll tell you, none of our clients will see that. I mean, we have exactly 0 clients who are 100% stock, right? We still do believe in owning some bonds at least. And we'll talk a little bit later about how we use those and kind of rebalance them. But I thought this was great and relatively optimistic. So high stocks. Can stocks stay high? I think what's interesting to talk about what you buy, usually when I ask people like, hey, what do you buy when you buy a stock? They say a piece of a company, right? My mom, when I was growing up, was trying to teach me about stocks. She quite frankly didn't know that much herself. And we had gotten some, I don't know, it's like from like opening up a savings account or, instead of getting a toaster, we got like 3 shares of stock or something like that. And it went to her name and, not my dad's. And it was like one of her things. So we would drive by. It was next to Somerset North in Troy. We would drive by the Standard Federal building. It was a beautiful new building. And she would say, we own like a door handle in that building because I own shares and I own a piece of that company. Right? So I think if you ask people like, what do you own when you own a stock? You might not get the door handle, but you get something like that. I own a piece of the company. I think if we define that a little bit more, right? You could say it in a different way, and you could say, I own the cash flows of that company. More specifically, I own the net present value of all of the future profits of that company. You don't own the door handle. You own the profit that those companies are generating. So that's what you're actually buying. We can look at, when you understand that, you can then say, well, let's look at price to earnings ratio and see if the price I have to pay right now is a good deal for those expected future cash flows, or is a bad deal for those expected future cash flows. So I get a little bit in the weeds here, so I know it's a little quantitative for some people's liking, but other people eat this stuff up. So sorry if you're not one of the people on this call or watching the replay that like, kind of the financial weeds. So simple, price to earnings ratio. There's something that you can calculate that is pretty popular called price to earnings. You just take the price of the stock, easy, and you divide it by the earnings per share, which you could find in 10 seconds if you care to Google it, and you come up with a factor or a number, right? That factor or number of the S&P is typically around 17. From kind of 1980 till now, it's averaged around 17. Meaning that if the market, if the price to earnings ratio is at 12, right, it would be a deal. That's a lower value than you expect to pay for a certain, amount of profit over the rest of your life that you own those shares. Right now, it's not 17 though. It's definitely not 12. It's 21, right? So again, if 17 is average price to earnings ratio, anything higher than that is like a little bit more than you would expect for the amount of profits that the companies are generating today, which is why people say the stock market is expensive, and it is. 21 is higher than 17, right? So it is. But I think if you look at what causes that, there's probably two things, and that's what the slide is about. Number one is, are these companies even generating profit? Like, are the profits increasing fast enough to support 21? And I don't know if they're increasing fast enough to support 21, but they're increasing fast. From 2020 to 2021, the estimates or the earnings per share increased 36%. These are not for little small companies like I own. These are for GM and Ford and General Electric. And I mean, that's the 500 biggest companies in America, right? The S&P 500. Even from this year till next year, they went up 11% again. These are huge numbers. That supports a higher stock valuation. The other thing that supports it, and I don't really think people talk about it enough or understand it, is what is your alternative, right? I might not be that great, but I'm not sure that Anna's alternatives in Metro Detroit are much better than me. So she's like pretty happy being married to me, right? Her alternatives are not that great. Doesn't mean I'm amazing. It just means the alternatives are generally worse than I am. I would say the same is true right now in investing, right? Stocks might be a little expensive, but what else are you going to buy? Are you going to go buy REITs and real estate in a world where maybe no one's ever going to go to the office again? Are you going to buy bonds that pay 0% interest? Right? So what are you going to go invest in if not for the stock market? And the answer to most people is nothing, so I might as well stick with the stock market. And that, I'm talking big investors, institutional investors, pension funds, not just our client base. So they stick with stocks because their alternatives are bad. Again, that's why I said if interest rates go up, it's bad for everyone in a million different ways if they go up fast. One of those ways is the government debt gets more expensive and more of our money goes there. So now we have bigger budget deficits, which causes interest rates to go up even more. It's kind of like an upward spiral. And this is another area that is strongly affected by that. So if interest rates go up, that's actually good. And I hope that happens, but again, slowly over the next few years. So I said actually in our last webinar, I said, hey, if interest rates hit like 2.5, the 10-year treasury hit 2.5, they were 1.2 at the time. So if they hit like 2.5, that's too high, and I think it's going to kind of slam the brakes on the economy. Well, that was 4 or 5 months ago, and they're only at 1.5. So again, the 10-year treasury is when we all buy government treasuries. We lend the government money. That's how they finance their debt. They pay us an interest rate. That interest rate is 1.5 today. It was 1.2 6 months ago. And if it was 2.5 today, I'd be worried. At 1.5, I'm not. Now, the Federal Reserve is going to potentially start what's called quantitative easing, which or the opposite. They're starting to pull back from their quantitative easing. So quantitative easing means is they're putting more money out there to stir up people to spend so that keep the economy going. That's what they wanted to do in COVID. Now they're going to start shrinking that. They're going to start pulling money back and saying, we're not going to give this out anymore because the economy can probably stand on its own 2 legs. If they do that well, and they do that slowly and over time, we'll probably be okay, right? It happened in 08. 08, they flooded the economy with money, kind of the opposite of Europe. We did awesome. They did horrible, right? So for anyone who said austerity was a good idea in 2008, you were wrong quantitatively. Europe did it. They did horrible, triple-dip recession for a decade. We came out of it and boomed and did amazingly well. They did the same thing again this time. Flood the whole system with money. Europe kind of caught on. They did the same thing this year that we did. They're doing much better as a result of that. Not better than us, but better in general than they could have been doing. So now they have to start shrinking that down. Again, last time they managed it very well. This time, we'll see. I hope they do it well. But this kind of like unwinding of the QE, or quantitative easing, this could start as early as next month. So we expect Federal Reserve Chairman Powell to probably say we're going to start tightening. It's called tightening, right? We're going to start tightening as early as October or November. Again, slowly but surely is fine. It's actually probably better because over 2 or 3 years, if interest rates come up, then this will continue happening for companies. So we might not see a booming stock market, but as companies are making more and more money, right, their price to earnings ratio will be supported because the E is earnings, right? So once the E is higher, right, then even if interest rates are higher and the alternatives look better, right, then the stock market won't get killed because it'll be a slow process and it'll be a healthier market because you can invest in bonds and actually earn 2 or 3%, maybe 4% in a corporate bond. Or you can invest in the stock market at a 17 to 18% price to earnings ratio. So again, interest rates, I think, are the big, I've been saying this for a year, are by far the biggest risk, but they haven't come up as much to cause a problem. I'm hoping that yellow line, if you remember, for that went straight down, you know, that could cause the dollar to also go down, which could then raise interest rates. That's something to watch. This 10-year treasury is definitely something to watch. How they contract the quantitative easing is something that's important to watch. So to me, these are all the things that could kill the economy. If you start taxing the average person instead of wealthy people, that's something to watch. But most of the things that they're talking about right now, I don't really believe are going to put the brakes on the party so fast that it's going to, again, interest rates worry me so much. It's what keeps me up at night because housing, I mean, now interest rates go up, housing comes down, right? Interest rates go up, more money, our deficit goes up because more money is going to finance that debt. Interest rates go up, the price of bonds comes down, the price of the stock market will come down because of what I just explained on price to earnings ratio. So interest rates coming up fast is by far the biggest problem. If that happened, we would do something in our firm kind of similar to what we did in COVID, where we would stop everything, we would cancel every single appointment, and we would look at every single client, 1,150 clients, and we would say, okay, you know, we would have, we would have all the admin people calling, all of the financial advisors, the guy that cuts the lawn, right? I mean, everyone would be calling and saying, hey, there's this huge change that's happening. Here's some things we might want to do in your portfolio. So right now that is not happening. So we're just going to kind of check out bonds. Again, we don't really own bonds. I don't think anyone thinks bonds are going to make money over the next 2 or 3 years, right? As interest rates come up, the bond prices go down, right? Interest rates are on an upswing for sure. So I don't think anyone here owns bonds to make any money, but we own a lot of them as a firm. The reason is for safety in your portfolio, right? It's a rock in your portfolio. So let's kind of talk about how some of this works. This, again, I talked about interest rates, kind of concerns me. I'll go through it fast. The 10-year treasury, you know, this is the average yield or interest rate. And the gold to copper ratio, to kind of divide the price of gold and copper, it usually tracks pretty close, right? It usually tracks interest rates. You could see for a while here, the gold copper ratio was lower than interest rates. Interest rates are probably artificially high then, right? Because people were worried, actually the market was overheating. So then, boom, interest rates came down and they came back into line. Well, now the gold to copper ratio is going up a little bit, and what's happening to interest rates? They're not keeping up. So if interest rates kind of come back up, I'm hoping the light blue line comes down a little bit, and then the dark blue line comes up a little bit, and it meets at like a nice equilibrium. That is manageable, right? We can digest that as an economy and as a stock market without having a huge crash. But if those interest rates catch right up to it quickly, especially in the next month or so, as Powell starts to shrink that quantitative easing, that's something to watch for. That's very, very, very important. And we will be watching that very closely. With this, again, I think bonds, most people don't really even understand them in the first place. So I tend not to spend too much time on them other than basically, this chart shows, will bonds make any money in the next 2 years? And the answer is probably no, right? Interest rates are going to come up, bonds are going to lose a little bit of value, and they're not going to make much, but they're not going to lose much. How we're using them as a firm is as a conservative portion of the portfolio, you know, in addition to maybe a few other things depending on the client, as well as a holding tank for rebalancing. So we rebalance every 3 months. In 2019, as the stock market was booming because of the Trump corporate tax cuts, you know, we were selling stock every 3 months and buying bonds. Then when COVID happened, the market came down 40% in 40 days. We had bought all those bonds the year before. Those bonds didn't lose really any value. So we sold a bunch of them and bought within 5 business days of the exact bottom of the market, right? Not because we're geniuses, but because it was time, right? It was that quarter. It was time to rebalance. We sell when things are high and we buy when they're low. So we took a bunch of the bonds out that lost no money, bought the stock market while it was down 40%, and it's up like 70% since then. So now for the last year and a half, what we've been doing is the opposite. Stock market goes up, we've been selling and putting them in bonds. And now if the market comes down over the next several months, we will have bought a bunch more bonds and we'll buy the stock market while it's really low and we'll ride it back up and then we'll start selling some of those gains out. So we use them as a rebalancing tool more than we want to make money on the investment and as a cornerstone of your portfolio that's not going to drop. And this next slide kind of shows that. So here is when the Treasury securities have done positive when equities were down. So here's the stock market losses. And again, these are just in 1 month. So you can see like there's almost 20% in 1 month that was lost at one point. And so when the stock market goes way down, this blue color, this light blue is what bonds do. So as you can see, almost all of the time, they do fine, right? So while the stock market's down, you can see in any given month, you can see they're down 5 or 10%. Almost every single time, the bonds are doing fine. This is the exception, and this was in 2008 because it was a banking crisis. When there's a banking crisis, interest rates don't work how they usually do, and bonds do lose a little bit of their value as well. But in any other sort of crisis other than banking, as you can see, I mean, even out here, what does that look like? Maybe 0.5% loss. So that's why we do own some bonds still in our portfolios. So again, we don't expect them to go to be like this amazing, income driver. But we do expect them to hold up if the market does drop and if we're wrong. And if one of these things, whether it's inflation slams us or interest rates, which I think is the most likely one, slams us, or Biden's tax increases, hurt the economy more than everyone is going to think, and corporations basically just get scared of it and stop spending. That's a problem. So, I mean, there are things that can happen, and that just in case we want to still own some bonds, and we're going to rebalance in and out of them, so we don't own there's just the same ones forever. So kind of in summary, what I would say is, if we can kind of get through the bond ones here, that of all of the things that are out there, Fed stimulus kind of going away, right? The Fed's shrinking their balance sheet. If that gets bungled, that could kill the market. They hadn't bungled it last time. And I think that they're trying to communicate very efficiently. They've been telling us for 6 months that quantitative easing is probably going to happen in the fourth quarter, which is like tomorrow. So we would expect that to happen soon. And it's not a surprise. They've been telegraphing that and telling us. As long as they do it slowly, which it looks like they're going to, I don't expect that to kill the market. Inflation is something that I think is a problem, like just supply chain problems and inflation. The Federal Reserve Chairman Powell thinks that is not that big of a deal. And because he is a little bit more powerful than I am, we should listen to him. So he believes that inflation is going to go away effectively over the next 6 to 8 months, because supply chains will kind of get figured out. And, we're going to be able to get like the billion things from China over to here and start like a more typical system. Plus, it takes a year or two to build plants. So people that want to insource, or onshore some of their supply chain, those plants will be coming online. So Powell doesn't really worry about inflation. If inflation is big in 6 months, that's going to be a problem, and that could tank the economy. Because once inflation is high, what has to go up? My number one concern, interest rates, right? And interest rates go up, and there's 5 or 6 other things then that hurts. So inflation in and of itself is not bad. Do you guys remember? I mean, I feel like I talked for 10 years about, oh my gosh, there's going to be deflation, and we're going to be Japan. Like, we need to figure out how to make inflation. Now there's some inflation, and everyone says, oh my gosh, we've got too much inflation. So I personally just feel like a year or two of 4% inflation is not going to kill anyone. Now, 3 years of 10% inflation, right? Now you're Argentina. So you do have to absolutely watch it, but I think we're like nowhere. I mean, if we're in like a spectrum of 1 to 10 of inflation, 10 being like a huge problem, it's like a 3 right now, maybe. It's probably a bigger deal to people's pocketbooks, and their wallets and their purses than it is the actual stock market. Because, even my wife has mentioned, she's like, man, my grocery bill's going up. The only plug-in hybrid SUV I could find that was a couple years old takes premium gas. I paid like $3.80 for premium gas today. So I noticed that is going up as well. So I think that inflation is going to maybe like hurt people's spending a little bit. But again, I don't even think that's that much, and I don't think it's enough to really hurt the stock market. And if it is, that's going to be a problem because more of interest rates. So I don't think taxes are going to be the thing that's going to knock it down. It's just not going to be enough. Now, does that mean I expect the market to be up 20% a year? No, because I expect all of these things to impact it a little bit. So my hope is that earnings can go up by 10 to 12, 13% a year, which would then cause the market to go up by an equal amount. But then you start to see a shrinking of that price to earnings ratio. So yeah, earnings might be up 10%. So you'd think the market's up 10, but instead it only goes up 5 because price to earnings ratio contracted a little bit. So where you would suspect an 11 to 13% increase in profit should lead to an 11 to 13% increase in the stock market, it won't. It might be like 6, because there'll be, another 5 to 7% in price to earnings contraction, getting us back to normal, which would be great if that happened if over the next 2 years, profits are up 10 to 12, 11 to 13%, but the market was only up 5 or 6, and interest rates slowly came up and got back to a typical like 2.5 to 3% on the 10-year Treasury over the next 3 years. And our price to earnings was back to 17 or 18. Interest rates were back to normal. The government had stopped quantitative easing and inflation had leveled out at 2.5%. We'd be in a Goldilocks economy, right? That could now sustain for another 6 or 7 years, and we could get close to the 10 years that we were at before. So as long as everything gets back to normal over the next, I think, let's say 3 years, even 2 to 4, I think we're going to be okay. Anything that kind of slams into us, though, because these valuations are so high, they're teetery, and they could come down fast. So I think from our perspective, that's like what we're really looking for is anything slamming into us instead of going up gradually. And if it goes up gradually and we could expect single digits, mid single digits in the stock market for the next 3 years, I'd be ecstatic. Because then after that, I know the next 5 to 7 years could look awesome because we'd be like kind of right back to where we were a couple of years ago, like right in this Goldilocks economy. And anyone who's not working, tell them to go to work because that worries me a little bit too, that we don't really have enough workers. But again, I don't know if that's going to necessarily kill the economy. I think it'll kill certain sectors of the economy. Like the other day, I had to drop my son off at his tutor, and we went to look for food, and we tried like 4 fast food places. They were all closed because they don't have any workers. So I don't know how important fast food is to the economy. I would guess probably not that important. And who knows, maybe we'll all be healthier and use less healthcare as a result of not being able to go to fast food. So with that, that's about it. So in summary, if it's steady, we should be good. If anything slams into us, we'll have to watch it super close. And even that might not derail us. So if there's any questions, now would kind of be the time, I think. So you can either turn on your screen. I'll see if I can kind of see everyone here. So you can either turn on your screen or physically raise your hand. You could just unmute yourself and blurt it out is also, I'm totally comfortable with that. So is there any questions from anyone? Hey, Tom.
The debt limit, can you comment on that? Is it something that we need? There's talk that in some sectors that they want to eliminate that.
No, I mean, the debt ceiling, so we don't default on our debt. I mean, we've hit that debt ceiling, I think it's 5 or 6 times, and in a day or two, it's fixed. Schumer came out today and put something on the floor of the House that said, hey, we're going to do these things and we're going to raise it. It's just like this weird game of chicken, in my opinion. And even if we hit it every once in a while, I mean, like I said, we've hit it 5 or 6 times, and I don't feel like I'm living in the Congo, like we're still, people are still buying our debt, right, at 1%, so it's just something that I don't really, quite frankly, worry that much about. Now, if McConnell digs in his heels and he's like, we're not voting for anything under any circumstance, but why would he do that? I mean, why would you want to be the architect of the downfall of America's financial system? I mean, it doesn't sound like that's something that would lead to a lot of votes. So, when the Republicans were spending money like crazy, right, the Democrats dug in their heels. And now that the Democrats are spending money like crazy, the Republicans want to do the same thing. So, they're both going to spend money like crazy. They're eventually both going to raise their debt ceiling because you have to. So, I worried about it so much in like 08 and 09. And now I feel like we've done this a million times. I wish they would just do away with it so we didn't even have to talk about it, but I don't really think it's going to be that big of a problem. Oh, hey, Bill.
Can you give me the list for the Goldilocks economy, inflation, all the details again? I didn't write them down fast enough.
Yeah, I mean, so I think in 3 years, let's say, if the PE ratio of the S&P 500 is 17,
Okay.
17 or 18 even, right? So if we get some like good earnings, which therefore shrinks the PE because the market doesn't grow as much, in 3 years, if we could be at 17 or 18, the 10-year Treasury, is maybe 2.5 to 3.
Okay.
I think that would be very healthy, right? It would give people an alternative. Retired people could have a nice conservative place to put money and get a decent rate on it. I think having a normalized interest rate environment would be better for savers, quite frankly. Unemployment would still be low. I mean, I would say unemployment would be 6%. I'd be happy with, because about 5. Once you start to hit to like 3 to 5, it starts to cause a lot of inflation. So I like an unemployment rate closer to 5 or 6 than I do like 3, for example. So if unemployment's at 6, 5, the S&P is at a 17, 3.5 or 2.5 to 3 on the, with relatively low inflation. So inflation would probably also have to be like the 2 to 2.5. So the Fed doesn't have to raise rates to attack inflation. But 2 is a super healthy rate. Like we don't want -1, or we don't even want 0. We want 2, right? If there's 2% inflation, guess what happens to the national debt? It effectively shrinks by 2%, right? So we want to have some inflation. It's very, very healthy for an economy. Deflation is a killer, right? It's killed Japan for 25 years.
Yep.
So I think if you had those 4 things, you'd have a super healthy economy in a couple of years that could last for a long, again, minus something slamming into it, that could just go for a really long time. It'd be great.
Perfect. Thanks.
Well, thank you, everyone. I really appreciate it. We'll put a replay up on our blog as well as our YouTube channel here in the next couple days once we get it cleaned up a little bit. So again, feel free, if you have any questions, shoot an email or a call to whatever advisor you are fortunate enough to work with here at AQuest. And I want to thank everyone for their time. I really, it's one of the probably last beautiful nights we'll have. And I will talk to everyone later.